A beginner's guide to stock investing. You can be able to raise your money several times over with time if you constantly invest your money. Because of this, it's crucial to start investing as soon as you have any money set aside for the purpose. Furthermore, a fantastic place to start is the stock market. You can begin whether you have $1,000 saved up or can simply afford an extra $25 per week. Remember that there is a lot you can and should learn about stock investing if you want to succeed financially. For the time being, read on for the procedure's first phases. Key lessons. Investing is the act of putting money or capital into a project in the hope of earning more money or making a profit. Investing, as opposed to consuming, puts money to work so it can increase over time. Losses are a possibility with investing, though. No matter their level of knowledge, investors frequently use the stock market to make long-term investments. Beginner investors have several options, including hiring professional advisors, using robo-advisors to handle their portfolios, and doing it yourself. Stages to begin investing. 1. Establish your level of risk tolerance. What is your risk tolerance, or how willing are you to take the potential of losing money if you invest? Stocks can be divided into a number of categories, including value stocks, aggressive growth stocks, high capitalization stocks, and small cap stocks. There are varying degrees of risk with each. You can focus your investment efforts on the stocks that complement your risk tolerance once you've established it. 2. Choose your investment goals. Determine your investment objectives as well. An online broker like Charles Schwab or Fidelity will ask you about your investing goals and the previously mentioned level of risk that you're willing to take when you open a brokerage account. An investment objective can be to raise the amount of money in your account if you're just starting out in your profession. If you're older, you might desire to make money in addition to building and safeguarding your wealth. Your investment objectives can be to save for college, buy a house, or support your retirement. Objectives might evolve throughout time. Just be careful to identify them and revisit them from time to time so you can stay focused on accomplishing them. 3. Choose your investing style. While some investors like to set it and forget it, others desire to actively manage their money. Though your choice could vary, choose a strategy to get going. You could manage your investments and portfolio on your own if you are confident in your knowledge and abilities in the field. You are able to invest in stocks, bonds, exchange-traded funds, ETFs, index funds, and mutual funds using traditional internet brokers like the two described above. You can get assistance from a seasoned broker or financial advisor with your investment choices, portfolio management, and portfolio adjustments. This is a wonderful choice for novices who recognize the value of investing yet may desire the assistance of a professional. An automated, hands-off alternative to working with a broker or financial advisor, robo-advisors are frequently less expensive. Your goals, level of risk tolerance, and other information are collected by a robo-advisor program, which then automatically invests for you. 4. Select your registered investment account. Retirement plan at work. If your employer offers a retirement plan at work, such as a 401k, you can invest in a variety of stock and bond mutual funds as well as target date funds through that plan. It might also provide the chance to purchase employer stock. After enrolling in a plan, automatic contributions are made at the level you specify. On your behalf, employers could make matching donations. Your account balance grows tax-deferred, and your donations are tax-deductible. This is an excellent approach to increase your investment returns with little work. Additionally, it can teach investors the discipline of consistent investing. An individual retirement account, IRA, or taxable account with a brokerage can also be used to begin stock investing, even in addition to having a workplace plan. Alternately, you could choose a standard, taxable brokerage account. You typically have a wide range of stock investment possibilities. Individual stocks, stock mutual funds, exchange-traded funds, ETFs, and stock options may be among them. A robo-advisor account uses your investment objectives to build a stock portfolio for you, as was previously mentioned. 5. Become more diverse to lower your risk. Understanding diversification in investments is crucial. Simply said, investing in a variety of assets, or diversification, lowers the danger that the performance of one investment will materially impede the return on your entire investment portfolio. It could be interpreted as slang for avoiding putting all of your money eggs in one basket. When investing in individual equities, diversification might be challenging if your budget is tight. For instance, you might only be able to invest in one or two businesses with just $1,000. There is a higher risk as a result. Mutual funds and ETFs can be useful in this situation. The majority of stocks and other investments are often held by both types of funds. As a result, they offer greater diversification than a single stock. Minimums to begin investing. There are minimal deposit amounts required by several banking institutions. In other words, until you make a particular number of deposits, they won't accept your account application. The price of stock investing. Fees and commissions. As economists like to say, nothing comes for free. All brokers must, in some capacity, profit from their clients. Typically, whether you purchase or sell stocks, your broker will charge a commission each time you trade equities. Trading commissions can be as high as $10 per trade or as low as $2. Some brokers don't even charge trading commissions, instead, they make up the difference in fees. Depending on how often you trade, these costs may stack up, have an impact on the return on your portfolio, and reduce the amount of money you have available for investment. Mutual funds. Mutual funds are expertly supervised collections of investor capital that concentrate their investments in several marketplaces. You should be informed that they charge a variety of fees. The management expense ratio is one of them, MER. The MER is a fee that mutual fund, or ETF, shareholders must pay, and the money goes toward the costs associated with maintaining the fund. It is based on the overall assets managed by a fund. The MER might fluctuate between 0.05 and 2% yearly. Keep in mind that the MER has a greater impact on the fund's overall performance the higher it is. Sales commissions may also be referred to as loads. Both front-end and back-end loads are examples of these. Before purchasing a fund, be sure you know if it has a sales burden. To avoid these fees, look at your broker's list of no-load and no-transaction fee funds. When opposed to the commissions levied when you buy individual equities, mutual fund fees could be more tolerable for novice investors. Additionally, you can start with a fund for less money than you would likely pay to buy individual equities. By minimizing the effects of volatility, investing consistently small amounts over time in a mutual fund can provide you with the advantages of dollar cost averaging, DCA. Online brokers. Brokers are either full service or discount. Full service brokers. As their name suggests, full-service brokers provide a wide range of conventional brokerage services, such as financial planning assistance for estate planning, retirement planning, college preparation, and other life events and possibilities. The greater costs they normally charge in comparison to other brokers are justified by the personalized assistance they provide. These may consist of a portion of your transactions, a portion of the assets you have under management, or occasionally a yearly membership fee. Minimum balances can begin at $25,000 per account. Discount brokers. Discount brokers were the unusual in the past but are now commonplace. You can choose your investments and place your orders using the tools they provide. A set it and forget it robo-advisory service is also provided by some, more below. A lot of companies offer instructional resources on their websites and mobile apps, which can be beneficial for new investors. Some brokers have relatively lax, or non-existent, minimum deposit requirements. They might, however, have additional conditions and costs. As you search for a brokerage account that satisfies your stock investment requirements, make sure to look into both of these. Through an impartial evaluation process, we give our recommendations for the best items, and we are not influenced by ads. If you visit partners we recommend, we might get paid. For more information, see our advertiser disclosure. Robo-advisors. The robo-advisor is a new type of investment advisor that emerged following the financial crisis of 2008. Betterment's John Stein and Eli Broverman are frequently cited as the pioneers in the field. Their goal was to streamline investing advice and reduce expenses for investors by utilizing technology. Other robo-first companies have been formed since Betterment's launch. Known online brokers like Charles Schwab have started to offer advising services similar to robo-advisors. 58% of Americans predict they will utilize some form of robo-advice by 2025, according to a Charles Schwab research. A robo-advisor might be right for you if you want an algorithm to handle all of your investing decisions, including tax loss harvesting and rebalancing. A robo-advisor may also be a good fit for you if your objective is to develop long-term wealth, as demonstrated by the success of index investing. Simulators for the stock market. A stock market simulator can be a useful tool for people who are new to trading and want to practice without jeopardizing any of their own money. There is a huge selection of trading simulators accessible, both paid and free. The use of Investopedia's simulator is totally free. Users of stock market simulators can invest fictitious, virtual funds in a portfolio of stocks, options, exchange-traded funds, or other securities. These simulators often monitor changes in investment price along with, depending on the simulator, additional noteworthy factors like trading costs or dividend payouts. Investors carry out virtual transactions as though they were carrying out actual transactions. Users of the simulator can learn about investing through this approach and experience the effects of their hypothetical investment selections without risking any of their own money. A further motivation to make wise investments is the ability to compete against other users in some simulators. What sets a full-service broker apart from a discount broker? A wide range of financial services, such as financial guidance for retirement, healthcare, education, and other goals, are offered by full-service brokers. They can also provide a wide range of instructional materials and financial items. They frequently call for significant investments and have historically catered to high-net-worth individuals. Discount brokers tend to offer a more streamlined range of services but have significantly lower entry requirements. Users are able to execute individual deals with discount brokers. They also provide instructional resources. What risks are involved in investing? A commitment to put money down today in order to achieve a financial goal is investing. Risk can be classified into many different categories, with some asset classes and financial products being intrinsically considerably riskier than others. Risk is a component of all investing. There is always a chance that your investment's value won't rise over time. How to manage risk in order to accomplish financial goals, whether they be short or long-term, is thus a crucial factor for investors to take into account. How do fees and commissions operate? Customers typically pay commission to brokers for each trade. These charges may exceed $10 each trade. Investors typically believe it is prudent to keep their overall number of trades to a minimum in order to reduce their exposure to commission charges. Exchange-traded funds, among other investing options, charge fees to cover the costs of fund management. Summary: you can invest in stocks with a fair amount of cash if you're just getting started as an investor. To ascertain your investment objectives, risk tolerance, and the expenses related to stock and mutual fund investing, you will need to perform some research. Additionally, you should research several brokers to see which may best meet your demands and to understand their unique requirements. Once you do, you'll be in a good position to benefit from the significant financial upside that stocks can offer you over time.